Hi, my name is Stuart Barron. I'm National Director of Research for Cushman & Wakefield, and thanks for joining me for Q2 2015 Market Watch. The first quarter of this year was the first time that we were able to see a significant impact of sustained lower oil prices on Canadian markets. And what we saw was over 2 million square feet of space return to market. So when we had a look at the second quarter stats, the question was, how deep does the rabbit hole go? And I was quite surprised to find that Class A absorption across central markets was in excess of 600,000 square feet. That, to me, speaks about expansionary momentum. The question is that actually what happened? And the answer is, no, it isn't. The first observation I'm going to make is about downtown Calgary. Central Calgary saw over 800,000 square feet return to market in the second quarter. That means a total over the first 2 quarters in excess of 2 million square feet. And that speaks all about oil companies bringing space to market, trying to convert an asset to improve profitability as they look forward. Now, the one thing to remember about downtown Calgary, which is going to experience more pain before it sees some gain, is that long-run absorption is about 175,000 square feet a quarter, and it can rise when oil prices begin to recover as high as 400,000 square feet a quarter. Now, that tells me that Calgary can get out of trouble faster than it got into trouble. And from an investment perspective, that spells opportunity. Now, the second observation I'm going to make is about downtown Vancouver. We actually saw positive absorption in central Vancouver of about 585,000 square feet. But last time I spoke, we spoke about kind of neutral momentum over 2015. So what's happening? The reality is that with all the new developments arriving at market, all of those tenants who committed 2 and 3 years ago are now relocating into those new towers. And there is a substantial expansionary component to those commitments. And that's what we're seeing impact absorption in today's marketplace. It is not the existing tenants making today's decisions that are leading to expansionary growth. So this is exactly what we expected. We've got high growth, but not expansionary growth in downtown Vancouver in Q2 15. Now, the third observation is about downtown Toronto. Over 300,000 square feet of positive absorption across all classes in the second quarter, and we're seeing the older stock of AAA vacancy begin to rise, in fact hitting 7.2%. We're also seeing Class A in the downtown North market rising, now at 8.4%, much higher than the downtown average. Now, if you look at the downtown South market, of course, where we've seen a substantial number of new developments, vacancies actually fallen to 1.7%. So we can really see that tenants in the marketplace are very interested, number one, in the efficiencies of the new developments in downtown Toronto, and number two, in the proximity to what is probably considered the new center ice Union Station. Lots of opportunities as we look out over the next 2 to 3 years, an awful lot of space returning to market, and yet strong growth creating a balanced market in downtown Toronto. Those are my observations for Q2 15. Thanks for joining me for Cushman & Wakefield's second quarter Market Watch.